with the
It's recording because we're going to start chatting right now. All right. You can still hear me clearly?
I can hear you, no problem.
Wonderful. Did I tell you what my my word for the year is, Dorie?
Oh,
My word for the year is pivot.
Ah.
And I used it, I got an acronym for pivot. So my acronym for pivot is persevering in very opposing times.
That's awesome. I feel like you almost stole it. That's an amazing.
Thank you.
That's an amazing acronym. I love
Thank
it.
you. You know what? I can't take the only credit. My fellas here, we sat down and we came up with it. But I really feel like that's the word of the year. Like for me, there has been so many things. You and I both know we don't need to get into it that have really sort of affected, you know, what is going on right now in the world.
Mm-hmm.
And it is global, right? Like,
yeah.
So, do we have, is it live? Yeah. Okay, so he's just
checking
to ensure that it's live. And here we go. Oh, it, okay, so now he's playing. Okay, so can you twist it? Yay, okay. My producer, I have my producer sitting next to me.
He's doing a fabulous job.
Yes, I think he is too. See, the live isn't even up. There we go. Ah, good evening, Marie. Thank you for joining us. So one of my clients just jumped on, and another, Jackie and Robert. So thank you for joining us. We're just going to give it a couple of minutes. And just to, you know, some people, sometimes they run a little bit late. But yeah, so that's my word. Persevere in very opposing times. Feel free to steal it, but you better copyright Selena Pollard.
Oh, of course. I'll give you all the credit.
Thanks, Dorie. Good evening, Howard. Thank you all for joining us this evening. We appreciate it, and we really hope that we're going to add some content here that's really going to just sort of help out anyone right now who is really concerned about what might be going on in the world and as it pertains to mortgages and what we should look to do with these mortgages. So yeah, so and we are just we are Dorie and Selena, aka the Orchid Ladies.
Yeah, we learned today that we love
which one is real and which one isn't. You guys can comment on that. Or are they both fake, or are they both real?
That's right. That is the question of the evening.
That is the most burning question of the evening. So anywho, okay, so we have got a couple of people in. It's now about 6:02. So I guess we just sort of, I just want to get started here. I want to appreciate those who have taken the time to join us, and I know others will be. So thank you for joining here for live episode 2 with Selena. This is my Wednesday Q&A that I have kind of turned into interviewing wonderful professionals like Dorie, who I'll get to in a moment. I want to respect everyone's time and tell you that we are probably going to be on for about 30 minutes, give or take. If this gets really exciting and intense and there are some questions that need answering, we run out of time, I promise, put the question in the comments and we will personally get back to you, okay? So as I was saying, so my name is, by the way, Selena Pollard Scott. I am a realtor, professional realtor, been doing this for about 26 years. My passion comes primarily from helping people attain their real estate goals, and no matter what those goals may be, buying, selling, investments, and you know, even if sometimes you have to pivot, persevere in very opposing times, even if you have to pivot and maybe come out of the market for a little bit. Just depends on what your life, what is happening in your life. So what I thought I'd do is interview some professionals and bring some professional expertise that I don't necessarily run in every day. And today I would love to welcome Dorie Stewart. Dorie is actually, so just a little bit about Dorie. Several years of experience in managing a team that coached successful entrepreneurs, and she parlayed her depth of experience then into her own business. She joined a busy mortgage office and in 2003, and she has now spent over 17 years helping people build their dreams, whether it be through first-time home ownership, investment purchases, refinancing, debt consolidation, whenever that need arises. She prides herself in working diligently to ensure a smooth and easy transition in the process while enjoying getting to know her clients. And I personally have enjoyed a long professional partnership with Dorie and count her as one of my elite alliances. So thank you for agreeing to do this today, Dorie.
You're most welcome.
Okay, so why don't we get right into it? Now, for some of you who are on watching us, you may be very experienced in this realm, and some aren't. So we want to just sort of start and just go through a few basics in terms of mortgages. So the first question that I know you're asked all the time as it relates to mortgages is, should I go with a variable or a fixed rate, and what is the difference?
All right, great question. I probably get that question every day. I think, first of all, I always like to ask the client, you know, it's a personal thing. What's the risk tolerance? I think the best way to start this conversation is to talk about what the difference is. So obviously, a fixed and a variable rate are two different kinds of mortgages, but the client has the choice to go either route. Doesn't matter whether the mortgage is with 5% down or 20% down, they certainly have the option to go with either type of loan. A variable rate mortgage is a floating rate mortgage. So what that means is that it doesn't necessarily stay the same the entire term. So typically clients take a 5-year term. Doesn't mean that all clients do, but typically if I were to go with the average, that's what clients take. So over a 5-year period, if you were to take a variable rate mortgage, you may see fluctuations in the rate, which will also mean it will change your payment. Now, right now we're in a climate where the variable rates are quite low. So if you were to take a variable rate right now, you're probably going to see those rates be low for at least a year and a half, just because of COVID and the pandemic and everything that's going on in the economy. But because you're starting at the bottom, chances are that rate will rise up over the term. And how it's determined, to make it the simplest way to describe it, is its sort of roots are in the overnight lending rate between the banks. The banks lend each other money, they determine a rate, and then that rate, again, is set, the Bank of Canada sets that rate, and then the bank goes and they offer a discount off of what you'll hear in the media, prime rate. What's the prime rate? Right now, prime rate is 2.45. So they may offer a discount, or in some cases, some of the lenders might say, okay, it's prime plus 0.10 basis points. So not a whole percent, 0.10 of a percent. So that's what a variable rate mortgage is. And again, just to reiterate, it does float around, it bounces around, because prime rate may change. It may stay the same for a year. It may change every 2 months. It may go up 1/4 percentage point, or it may drop down 1/4 percentage point. So any client that takes a variable rate mortgage has to be prepared for some fluctuations.
Got it.
You know, and depending how large the loan is, you know, they may see their payment jump up only $20, $30, or it may jump up $200. It's obviously dependent on what the loan amount is.
So what you had also said at the beginning is it depends on that person's lifestyle and their tolerance for risk. So that's a good question. So this is probably an unfair question right now. So would you say in this market, would you just stick with that, what you just said in this market, or do you have some advice about somebody who was getting in right now with all of the current market conditions? Would your advice still be the same? Depends on their tolerance, or would it be specific at this time?
I mean, I think there's a little bit of give either way. You know, whenever I speak to a client, I kind of try and figure out what their 5-year plan is too, because that's an important thing. And I will mention one other thing about the variable rate. Maybe I'll get back to that once I just explain what a fixed rate mortgage is. So variable rate mortgage, one of there's a couple of silver linings to it. Over history, they've said 95% of the time, a person who takes a variable rate generally comes out on top over a 5-year period.
Okay.
Now, obviously, we're in a strange time.
Yeah.
I don't know, because you're starting at the bottom, if you were to take a mortgage right now, whether that would hold true.
Right.
But that's something to consider. The other thing about a variable rate mortgage is if you intend to make a move or you need to make a change, a variable rate mortgage comes in handy because the penalty will only ever be 3 months interest if you're exiting that mortgage, if you remain in a variable rate the entire term. And I will mention one other thing about the variable rate before I get into the fixed rate, is that when you're in a variable rate mortgage, every lender allows you to lock into a fixed rate. So if all of a sudden the variable rate kept climbing and your payment kept going up and you're like, I'm getting nervous, I'm going to lock it. You can lock in, but remember, you're locking into whatever the bank is offering at the time of that lock-in.
Got it. Okay.
So it's something to consider.
I have a question, 2 questions from Deborah. One is, what is the average variable rate right now? And 2 is, what's a good fixed rate now?
Okay, so I will answer the variable rate, average variable rate right now. It's kind of a trick question because it depends on whether, and I know this could be complicated, the mortgage landscape has changed so much lately because when B20 came in, all these rules changed on how banks set their pricing. So with certain deals, if you're doing a refinance, if you're doing a purchase, or if it's CMHC insured, the actual rate will differ depending on what kind of mortgage you're looking for. But to give you sort of an average of what I've been seeing lately, you're sort of seeing rates of prime less 20, prime less 25, prime less 30, maybe prime less 35. So prime is at 2.45%, you know, so obviously you're taking that discount off that 2.45 and that would be your net rate. But remember, it can change over the term, but that's what you'd be starting with if prime remained at 2.45 when you close the mortgage.
Okay.
Now to get into the fixed rates, let me at least quickly talk about what a fixed rate mortgage is.
All right.
Fixed rate is determined on the bond rates, the bond market. So the bonds are set, you know, they're looking at, you know, the 5-year bonds, those rates are set. And so they're not an overnight lending rate. They're not fluctuating. They know what's going to be happening over a period of time. So when you close, they're hedging, okay, we're going to, you know, make the XYZ on this, and then the banks are putting a little bit of a surplus on it to make their interest in their money. So a fixed rate mortgage remains the same the entire 5 years. So if you get a rate of 2.59% right now, for instance, that's one of the rates that's going. It depends what you're doing. If you're refinancing, the rates are higher. Okay. If you're doing an insured mortgage, the rates are lower. So again, I can't really speak to exactly what a good rate is right now because it really depends on what kind of mortgage you need. Right. But the one thing to remember about a fixed rate mortgage is if in the interim of those 5 years in the short term that you're planning on breaking out of that mortgage, be prepared that it's possible that you may end up having to pay quite a large penalty. Okay. A 5-year mortgage can be great. It can be wonderful for that first-time buyer that doesn't want any fluctuation. Right. And right now we're in historic lows still. Like we're in that realm, you know. You know, the rates are fabulous. So if you know you're going to be, you know, set for the next 5 years in that property, then for sure, by all means, it might not be a bad idea to take a fixed rate if you're more comfortable with knowing your exact payment every time.
Right. Okay. All right. Well, that sounds good. And again, that goes back to the person's tolerance as well.
Absolutely. What you're comfortable with.
Okay. So I know there was a question from Jacqueline that came in a little while ago, and we just have some issues. So we're going to deal with that momentarily, Jacqueline. We're not hearing your question. So very quickly, if you can speak to what an insured mortgage is
Yeah.
And then if you can also answer, because you mentioned B20 a moment ago, and what is a stress test? That was something that came out just about nearly 2 years ago now, otherwise known as a B20 stress test. So let's just kind of address that. And
okay, what do you want me to start? I'll start with the
what?
Okay, I'll start with a stress test. I will. So the stress test was created because basically the government just decided they wanted to make sure that the client was prepared if there was some sort of an adjustment in rates after they took a 5-year term or whatever, a 2-year term, 3-year term, that the client would still have the ability to pay that loan. So previous to B20, we were able to qualify deals on the actual rate. So say, for instance, a client was getting a rate of 2.59 or 69%, that's what we would use to qualify the rate. After B20 and those changes came into play and we had to qualify based on the stress test, that stress test rate was set. And it's been as high as 5.195. I think it's 5.64 at one point, or 5. They escape me because they changed so much. Right now, it lowered to 4.94, which is helpful. But you can imagine someone who is taking a mortgage. They're taking a fixed mortgage and the mortgage rate is 259, and they can't understand why they can't qualify for more money. It's because we have no choice. We have to use that stress test number, and it's really to protect the client in case there is a jump in rates after their mortgage renews.
So what you're saying
is that client going to be able to make those payments later?
What you're saying is that the government and the banks are trying to protect us from our own self. That's what you're saying.
Basically.
And just to make it clear, it is what you qualify on, but you still get your 2.59% interest. So that's one of the things that we wanted to clear up. And okay, so and I had asked, so Jacqueline had asked, my bank suggested that I could do half variable and half fixed rate. Would you agree that this is a good idea?
I'll say yes personally, but again, it depends on the client. But I just did that myself.
Oh, well,
so I have, I enjoy taking risk, but I don't want to put all my eggs in one basket. So it's nice to have the option to have some of it flexible and some of it not flexible. So for me personally, I think it's great to do that option. It doesn't always work out for everyone. Again, if there's risk tolerance issues, you might not want to have any part of it variable because you don't want to deal with that fluctuation. Right? But it's not a bad idea.
Okay. I like it. So let's just speak to the first-time home buyer. And the question that obviously comes up quite a bit is, how much do I need to put down as a first-time home buyer? And how much do I need if I'm not a first-time home buyer?
So I think this is a myth in the marketplace. I think people think that the only way to be able to put 5% down is if you're first time home buyer. The reality is that's not the truth.
Right.
Anybody can put 5% down. The difference with a first time home buyer is that you're able to take advantage of some rebates as far as land transfer tax goes. So there's savings there. But as far as the mortgage itself, if you I should clarify, for an owner-occupied property. If you're buying an investment property or
that's another conversation.
That's another conversation.
Maybe we'll touch on that a little bit after we finish this.
Yeah, but I mean, once you say, for instance, you're in your first home and you want to move up, and the price point that you want to move up to, you still haven't built up enough equity in your own home, and you still can only put 10% down on that new home you're moving into, then absolutely, you can purchase that property. Right. And, it doesn't, or 5%, like I said, there is no, the real benefit for the first time home buyer is just those rebates as far as the closing costs go.
Got it. So Robert asks, what type of costs will be associated with a fixed rate mortgage if you decide to cancel or sell in the middle of a 5-year term, for example? And are these costs negotiable when arranging a mortgage? And I want to add to that, one of the things that I have seen lately was this article that came out with this this individual who was selling and encountered a $30,000 discharge. And maybe you can speak to that right now. And one more thing, speak to monoline, because I just heard that word the other day. Yeah. And that was kind of an answer to that. So there you go.
Okay, so let me start. First of all, it's impossible for anyone to predict what the penalty would be on a fixed rate mortgage, because it's very dependent on what's going on in the market at the time that you're breaking out.
Okay.
So what the big banks do is they will take the original rate before they discount it. So it's like their sort of posted rate before they discounted it. So say, for instance, you had a rate of 3% on your mortgage, but really the bank started off at 4.5%. That was their posted rate when you took that mortgage, right? Mm-hmm. What they will do is they will do a difference between the spread of what the current market rate is and what that posted rate was. And then they have a calculation. And I can add to this too, the formula isn't simple. Some of the banks are slightly different. It's not like they all follow the same rule as how they calculate that penalty. Mm-hmm. So, and there's other factors involved too. How many months are left in the term, right? And obviously what the outstanding loan amount is.
Sure.
So that formula is calculated at the time of breakout. So say, for instance, you're planning a move, you call the lender. You call up Selena saying, it's time, I want to look for a new house. You call up the lender just to find out what your penalty is to break out. And the bank says, well, as of today, your penalty is $7,500. But they'll also warn you that that is just an estimate. The penalty will be calculated generally maybe 3 or 4 days before closing, because they cannot predict what's going to happen with the rates.
What is happening in the rates that day. Got it.
Okay. Yes. So it's very important to take notice of that there could be change in what they quoted you. And then by the time you actually break out of that loan, I mean, the penalty might be better or it might be worse. Sure. It really depends on what's going on with the market. Now, one thing to add and to sort of tie into the whole thing about that TD situation, yes. You cannot really negotiate with the banks on the penalty. The penalty is a done deal.
It's what it is.
It is what it is. Will they take mercy on some clients? Very rarely.
That's sobering.
Yes, I know, it's unfortunate. I've never been able to get a bank to say, okay, we're going to reduce the penalty by X, Y, Z. Sometimes what the bank will do is they will reduce the penalty, say by 20%, if you take the new mortgage back to them.
Right, got it.
That's one possibility.
Right.
But the other thing is that, I know TD was highlighted, but the truth of the matter is it's in the mortgage documents, it's in the write-up. Do your research when you're getting that loan. Make sure you understand the terms of that loan. Work with a mortgage professional that highlights that stuff. But you also have to remember to ask those questions too, and just make sure you're very clear on it. Because after 3 years, you might completely forget the conversation that you had. Yeah. So it's very important to remember that. And all the big banks generally have that same policy, which is what I'm going to segue into as far as the monoline. Yes. So a monoline is a lender that really only deals with mortgages. They don't do bank deposits. They don't do RSPs. They don't do any type of investing other than strictly mortgages. That's all they deal with.
Sure.
So as far as mortgages go, because they only deal in mortgages, they don't have these funny posted rates when they're calculating their penalties. So when they calculate a penalty, like I would say 10 times out of 10, you're going to pay a lower penalty on a fixed rate mortgage if you're with a monoline. To give you an example of who some of the monolines are out there, and if you want to do your research and look them up online, generally you got to go through a broker if you're going to get one of those banks. But, you know, it's places like First National, MCAP, Merrick's, RFA, RMG. There's numerous lenders out there. Some of the credit unions also have the same policies, like Meridian. You know, I'm trying to say, you know, off the top of my head, there's several, right?
Right.
So there are options to go that route. So for instance, it might be to your advantage if you're wanting to take a fixed rate, but you have uncertainty about what your 5 years are going to be. Then for sure steer towards one of those lenders, even if their rate is a tiny bit higher.
Right. When you do the full calculation and the what ifs,
Yes.
it's worth it. So, and this is the point that I think we've been discussing lately, is, you know, if you are thinking about making a purchase right now, and by the way, we just got our new market stats today, and anybody here who wants to know what the new market stats are, hit me up. I will send it out to you personally, but they're favorable. They had gone down. We had a big drop off. I think it was in March or whatever, but they've gone back up again, and prices are up 5% over. So you know, the market is still moving. Buyers are still getting more comfortable with going out now, even with COVID, which we're going to talk about in a second. But you know, with, you know, some job uncertainty, there's some job uncertainty happening right now. People still have their job, but they're concerned about maybe their job certainty or maybe their partners. So maybe this would be a great solution for people. If you're not in one of those, you know, frontline worker or one of those places that are in high demand, and those jobs that have gone up in high demand, and you do have some uncertainty, maybe this monoline is something that you might want to look into. Because
best of both worlds, basically, right? You're able to get that stability, but if you do have to break out midterm, you're for sure going to be faced with a lower penalty.
Right. Okay. Ashraf had a question, and Ashraf, perhaps you weren't on earlier. You asked, how much is the down payment for a first-time homeowner, please? And we had addressed that earlier of being 5%. And I can get back in touch with you and maybe provide you with some more information about that after this, because we're actually running into the 30 minutes. We're 20 minutes.
Boy, that went fast.
So first, I want to talk about three things. I want to talk about three things before we jump off, and I hope that we can get these in. So I have heard that the government is thinking of increasing the payment to, Ashraf, to your point, I've heard that they've been thinking about increasing it, to 10%. Can you speak to any validity to that? That's one of my questions.
I've heard rumblings of it, but I'll be honest with you, I don't think it's going to come to fruition. Certainly, it's not going to come to fruition anytime soon.
Okay.
You know, we're in the middle of, still in the middle of a pandemic. They're not going to be putting that stress on buyers right now.
Right.
So I think for now, you're safe.
Okay.
If you're considering a purchase, call Selena, you know, get your ducks lined up. You know, the time is now. The
best time to buy real estate was yesterday.
Yeah. But you know, like, things are good out there. You know, things are starting to move. I know that because I'm super busy. So, and you know, again, if anything, at least the you know, if there's a silver lining to what we've been going through, is that the rates are quite reasonable right now, and it really helps, you know, on the bottom line, because of course, you know, I know there's still that qualifying rate that we have to use, but the actual payment that you need to make each month makes a difference as well. You want to feel comfortable with what you're paying. So,
and my second question is, how has COVID affected mortgage lending?
Yes, I would say in general, basically, maybe some of the conditions become a little tighter. They're a little pickier about making sure that we're getting pay stubs shortly before closing. So they may have asked for a pay stub 2 months before. They may ask for another one a couple weeks before. So consumers need to be prepared for that, because it's possible that if they lost their job in between that time, I don't want to say that the lender would walk away from the deal. They just want to know. I mean, they do have some policies in place that if the deal was approved and they had, valid proof that the client was working, but they're not necessarily going to say, see you later and leave you high and dry, right? They do have somewhat of a heart. But, there are some tightening on rules, especially when we start doing some of our alternative lending. They're requiring more paperwork, more backup, because of course they're taking more risk. These are for clients that have poor credit, or maybe they don't show a lot of income on paper. So those are the people that those are the deals, that we have to work a little harder on, as far as providing, and satisfying all the conditions that the lender's asking for.
Right. Okay.
Yeah.
Okay. And I wanted to say something, and then I wanted to ask you for a tidbit. I know that we're at 6:30 right now. So to the wonderful viewers who have joined today, I've been fortunate to be in this industry for 26 years, and I wholeheartedly stand by mortgage brokers. Every one of my clients, every time I have a conversation with them, I say, unless you can go in and say, hi, Bob, to your bank manager, and he can say, hi, Selena, you are probably going to get your best bang to go and use a mortgage broker. And the reason why is simply that you guys have a lot of relationships with a ton of different lenders out there, including the big banks. You guys can package their thing properly. You can advise them properly, and you're not just pushing one tool. So I think that, and ladies and gentlemen, mortgage broker is no cost to you. The lender is the one who pays them. So it is so worth it to have somebody like Dorie in your corner, because she'll work for you. She will work to get you the best terms and the best rate according to your situation. We talked a little earlier about your lifestyle and level of risk, and these are things that a Dorie will speak to you about, as opposed to somebody when you walk into ABC Bank. So I just really wanted to say that because I wholeheartedly believe in that. And the last thing I just wanted to address is something that you spoke about earlier. Dorie had mentioned to me that she had gotten something from Equifax, and it was more to do with right now, with people struggling right now. There are places that are doing some forgiveness, whether it be interest rates or things like that. And I think you mentioned that there are a number of websites on it. Can you just speak a little bit to that? About 30 seconds.
For those of you that don't know, Equifax is one of the main credit reporting companies that supply the banks and basically rate your credit. So they come out with this FICO or Beacon score when we pull your credit bureau. So right now, they've actually, just as of today, released a whole bunch of links that will answer a bunch of your questions, because I think some clients are wondering, if they deferred their mortgage, how will it affect their credit? If they're late or what, or if they're just struggling altogether, what can be done to repair it? What are the things, be proactive. When it comes to credit, it's number one, it's paying attention and being proactive. Selena, we could probably do a whole other just on credit, because I could give tons of advice on all of that.
Right.
But, for sure, I have a bunch of links, so you can reach out to Selena.
Right.
And, if you just say, hey, I want to get some more information on these links that Dorie was talking about, then I'd be happy to pass those along to her. And one other thing I wanted to mention, and Selena, I forgot to tell you about this, but if I could take 2 minutes, because this is valuable.
Well, y'all, it's 2 more minutes. We apologize. Okay, go.
One of our lenders, one of our monoline lenders, came out with a program that I think is fabulous.
Okay.
And this program really works well for the first-time buyer. What it is that they're offering a cashback program that will be given to the client on closing, up to 3% of the loan amount. And basically what that means is that if the client has saved XYZ for down payment, it means they don't need to have anything more for closing costs. They don't need to have anything more for moving costs, for furniture, etc., because they'll be given a nice little lump sum on closing at the lawyer's office.
Wow.
Now, there is obviously the
I
bank.
wanted to know.
Yeah, they have to make their money.
Yeah.
But I think this program will work really well for some clients, because there's some clients that are struggling to even make that 5%
Sure.
down payment. So can you imagine if you've saved your 5%, you're struggling to save that extra for the closing costs. If you all of a sudden could use everything you saved towards a down payment, now all of a sudden you can qualify for a slightly higher purchase price.
Yes.
And you're going to end up with up to 3%. And what happens is, whatever their base rate is, if you decide to only take a 1% cash back, then they up the rate by 0.20, not 2%,
Right.
0.20%.
Right.
Then if you take 2%, it's 0.40. If you take 3%. So to give you an idea, this particular lender, if you wanted 3% at closing, the rate would be 309, which sounds ridiculously high. It really isn't in the grand scheme of things.
Mm-hmm.
If it will allow you those extra funds on closing.
Sure.
Because frankly, most people, when they move into a house, they need furniture, they need to paint, all those little things. Now, all of a sudden, at the lawyer's office on closing, you're going to have a little kitty you can work with. Also, that money can be used to pay out a debt. So if, in order for you to qualify for that loan, you have to pay off a $10,000 student loan that you don't have funds for,
right?
Guess what? They'll condition the lawyer to pay off that student loan with that cash back.
Sweet.
All of a sudden, guess what? You qualify for more.
For more. And as we know, borrowing mortgage money is the cheapest money you can borrow.
Yes,
right?
Absolutely, absolutely. Now there's a few little conditions with that, but again, I encourage you, if you're interested, reach out to Selena, reach out to me, whatever you need to do, and we will connect you and tell you all about it.
Well, that is lovely. Well, Dorie, as everybody here knows, we obviously can go on and on, but we want to respect everybody's time. We want to thank you for joining. This video is going to be available after, and what I will do is, Dorie, I will put your email address in contact and my email address. There's a couple of questions we didn't get to, but I promise you we will address them. And I just want to remind you that was what was posted here. If you want to see the information on what has happened in the market over the last month, we're going to be posting that on our Thursday Spotlight tomorrow on our Facebook and our Instagram pages. So thank you again, Dorie, so much for your time. Bless you. Bless everybody out there. Thanks.
All right.
Good. Everybody have a lovely evening. Bye for now. Ciao.
Bye-bye.
Bye all. Thank you for joining.